Hi, Mike Almala, recovering CPA, back with this next lesson in financial accounting, a mercifully brief introduction. It's often helpful to compare current economic performance with past performance. It's also useful to utilize current performance to make projections about future performance. But in comparing present raw numbers on an income statement with past raw numbers, problems arise if over many accounting periods the nature and size of a firm's activity has changed dramatically. In the startup period, the volume of sales is not likely to be as great as the volumes achieved as a business matures. Also, the mix of products and services offered by a business may change dramatically over time. To compensate for changes in the scope and nature of business activities, financial statements are often converted to percentages. In converting raw numbers on an income statement to percentages, the total revenue or sales figure is usually used as the basis for percentage conversion. If a business has $100,000 in total revenue, this is converted to 100%. All expenses are converted to percentages by dividing the raw expense numbers into the raw total revenue number. For example, if the firm incurs $30,000 of salary expenses would be shown at 30%, 30,000 divided by 100,000. This joint ventures income statement illustrates the conversion of raw numbers to percentages. So how does the conversion of raw numbers to percentages improve the usefulness of multi-period statements? Well, despite changes in the scope of a firm's operations, the relationships between categories of revenue and expenses often remain relatively consistent. Wide variations in percentages from period to period indicate that significant changes in the structure and nature of the operations have taken place. The stability of the relationship between income and expense items explains how historical operating results can be used to construct operating budgets for future periods. For example, a company may expect its sales to decrease or increase significantly. If certain expenses have shown a stable percentage relationship to total revenue in the past, specific dollar amounts for these expenses can be budgeted based on the expected dollar amount of revenue. Now, the utility of past income statements in predicting future performance depends largely on the firm's economic environment. Some businesses operate in very stable, predictable economic climates, others do not. Economic stability is primarily a function of the demand for a firm's goods and services, the degree of competition, and the cost stability of required goods and services. Certain goods and services are more essential than others are. Other goods and services are not as essential. The overall demand for essential goods and services generally is more stable than the demand for less essential services. Demand for essential services is less likely to fluctuate with upturns and downturns in the economy than demand for less essential services. All other things being equal, a business that supplies essential goods and services will have a more predictable revenue stream than a business that supplies less essential goods and services. Thus, the revenue or sales component of the income statement of a business providing essential goods and services is more useful in predicting future revenue or sales than an income statement of a business providing less essential goods and services. The degree of competition a business faces is another key factor in the predictability of a firm's earnings. As a rule, the more competitors there are in a particular market, the less control each competitor has over the selling prices of its products or services. The less control a firm has over the prices it charges, the less predictable are its revenue and sales. Finally, the stability of factors of production varies from business to business as well. A business that sells coffee or high-quality chocolate can be adversely affected by rising prices of coffee and cocoa beans. Generally, the supply and cost of labor is more stable than the cost of many raw materials. Thus, the expenses of a service business tend to be more predictable than a business that sells or processes products. The most recent performance of a small business, as reflected in its income statement, may give little insight into its future performance simply because there is a great deal of risk in running any small firm. Even the most stable of small firms are vulnerable to unexpected disruptions. Because small businesses often rely on the services of the owner or a few key employees, these firms can be adversely affected or absolutely ruined if these contributions are lost or reduced. Death, disability, retirement, divorce, drug addiction, or burnout can turn a profitable small business into a losing one in a very short period of time. Any number of external events can also rapidly reverse the fortunes of previously successful small retail businesses. A plant or military base closing can quickly turn a prosperous community into a struggling one. A highway relocation or reconstruction can adversely affect traffic flow and lead to dramatic declines in revenue. The appearance of a Walmart or a Home Depot can spell doom to previously successful small businesses. In summary, an income statement may tell you if a business did well or badly in the most recent period, but it does not reveal why a business performed as it did. To really understand the business, you have to understand the economics of the products and services offered and the competitive position of the firm in its particular local or regional market. You also need to look at its future prospects. Sadly, the income statement and balance sheet alone cannot tell you why the firm performed as it did in the past or precisely how well it will perform in the future. So click here for the next lesson.